please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Welcome back. 5 years ago, in 2013, on Teachers' Day, Vetri Subramaniam, now Group President and Head of Equities at UTI, wrote a piece in Mint titled "To My Teacher, the Stock Market." We thought the best way to celebrate Teachers' Day here at CNBC TV18 is to invite one of this very good students, excellent students of the market, Vetri Subramaniam, to tell us how to learn from the stock markets. Vetri, good morning. Thank you very much for joining us. It's a lovely piece and I read it several times. I have read it several times. Let me begin with one of the quotes that most impressed me in that. George Santayana's quote, "Those who do not remember the past are condemned to repeat it." How would you apply this in the current market fall?
Well, without getting into the particulars about the fall, first of all, thanks for having me. I think it's a great occasion to celebrate, which is Teachers' Day. But I think, yes, those who, forget history are condemned to repeat it. And, maybe it's a different class which comes up for the exam every time. And the thing that is always striking to me is about how it's the same issue of a new paradigm, a new valuation regime. But the reality is that equities swing between the extremes of being very, very rich in terms of valuation, and then at some point they plumb the depths in terms of being traded cheaply. And it's virtually impossible to know beforehand what causes the valuations to move between those two extremes, because that is significantly driven by the emotions of people, by the sentiments of greed and sentiments of fear. So, but they do fluctuate between those two, and it's good to know that, and therefore the old, rule of buy low, sell high, I think still remains valid.
Vetri, hi, good morning. And happy Teachers' Day to you. Imagine even after 5 years, we're still talking about that piece and reminiscing on all those lessons. But just to go back to some of those, lessons, you talked about one. The other line I want to refer to is the challenge is not in identifying a good investment, but in committing to it in size. Now, this is the biggest problem, right? I mean, you buy a good stock, but then the market goes haywire, and then you don't know what to do. Have you stuck to this learning, or have you also has it been also hard for you in the past?
No, this is always hard because, it's very easy to go back and say if you bought 100 shares of XYZ, fill in the blanks with whichever stock has gone up 100x over the last 10 years, then you'd be worth so much today. But the challenge is that was it really a significant enough investment as a percentage of your net worth at that point of time to really make a difference? And one of the strange things about investing is that to make a lot of money, sometimes you need to have a lot of concentration, but to stay rich, you actually need to stay diversified. And you see this all over the marketplace that, people become very rich with a concentrated investment style, but once wealth goes up, you actually prefer to stay diversified. So it's not just about picking the right stock, it's about position sizing and having enough money invested in that stock for it to be able to make a difference to you.
Okay. Vetri, you begin by saying in that piece that you started your career in 1994, and as of 2003, the stock markets were 23% lower. A lot of people would have gone through this experience if they had entered around 2008. That's how they would have felt in a couple of years. Even those who would have entered much later, 2011, would have felt that by 2013. What would you advise them? What did that teach you? How do you stay invested when you see the market down 23%?
No, great question, Lata, and I think it was, pretty much trial by fire for me. And we obsessed so much about the macro, about all the problems that India faced during that period, the Asian crisis. I mean, there were multiple challenges during that period, political instability, whatnot, you name it, and we had those problems. But really what I learned during that period is that eventually investing boils down to picking good companies and then staying invested with them. Because remember, during that same time that I talk about where the market actually went down 23%, actually there were multiple stocks which gave you returns of 10x, 20x, 30x and 40x, because in a sense they were perhaps not so affected by the macro. But the crucial thing here is to understand that eventually you make money by picking companies. Obsessing about the macro is good, you should worry about it, it is a risk factor, but money is made eventually by picking the right companies and backing those entrepreneurs through difficult times. And to me, that was the biggest lesson, that during this period where markets actually went down over 9 years, there were many opportunities for you to be able to create wealth if you pick the right stock. So stock picking eventually matters, and nobody who's in the market should ever forget that.
Do you have any examples, any interesting anecdotes to share with us? I mean, what has your biggest learning been from any company or any stock that you bought?
More than a company or a stock, the two things, and, I think we were discussing this earlier. To me, particularly that whole run-up into 2000 when, the IT stocks went berserk, and then the meltdown after that. I think the two things which, just stood out for me at the end of that experience was A, valuations matter. It doesn't matter how great the story looks. Valuations eventually matter in terms of what your outcomes could be. And when I look at some of those peak prices of 2000 today and where those stocks are even now, almost 18 years later, the returns on some of them have been very, very poor. The second point is that at an individual level, asset allocation matters. I think in the late 90s leading up to 2000, I pretty much believed that being somebody in the market, you could almost have 100% invested in equities. And it was a very humbling experience to see my portfolio drop almost 80% from the peak in the early 2000s. And, in a way, it taught me about my own risk appetite. And I realized that, if I need to sleep well at night, I really can't afford to be 100% invested in an asset class, which will surprise you every now and then. Now, you could say 2000 was, one should have been aware that, valuations were excessive. But the point is, can you live with those kind of drawdowns? And the third thing that I would say, which was again a big lesson for me in 2000, because I think the real destruction that 2000 did, and I saw this at first-hand level, was the extent to which people had leveraged themselves in the market. And therefore, when those stock prices came down, it wasn't just stock prices coming down. These were real lives, and these were real people landing in a hell of a lot of debt because they'd been wiped out by the leverage that they had. And I think those to me were the three big lessons of what I learned during that whole period of 2000. And yes, the market can be irrational at times. Get used to it.
Oh yes, ice stocks were the flavor of the moment, weren't they? Vetri, actually I was going to ask you, what lessons did you draw from the next boom, the mother of all booms, 2003 to 2008?
Yeah, so, it's very interesting that you should ask that, Lata, because, it's very, in a sense, the fundamental investing toolkit stays the same, but the context keeps changing. And the strange thing about 2003, 2008 was suddenly how investing became all about macro. It was all about India's great macro. Actually, we stopped discussing companies so much, and the focus shifted to all about the great macro that we had, that we deserved a place at the world table. We were now a full-grown adult. We were no longer a company dependent on, foreign aid. And in a sense, therefore, both that boom was globally led, and even the fallout after that boom had significant global correlations. So it's very interesting because, the tests and the challenges that the market throws at you are different every time. So in a sense, the lessons of 2000, except for the bit about valuations, the bit about leverage, were not necessarily fully relevant in 2003, 2008, because it was more about macro. But again, I would say, end conclusions, the same three things: asset allocation matters, valuations matter, and please don't leverage. I think those were the consistent lessons, whichever boom or bust period you look at.
So the market, you say, has been your biggest teacher, but what about a flesh and blood teacher? I mean, any corporate, any business market veteran that has taught you your biggest learnings?
Well, many of them, I'd say it's been amalgam, though I have in the past highlighted my, first boss in the stock market as somebody from whom I learned a lot. But, I'd say many people, and that's the great thing about the stock market. There's not just one teacher. There are so many people. There's a wealth of data. There are so many people who've written deeply personal accounts of their own style of investing, their philosophy of investing. So actually, in that sense, this is like a buffet, and you're spoilt for choice. So, go out there, learn from those experiences, and you'll find your own teacher, the one who works for you. It's not a question of who's the right teacher or the wrong teacher. So it's just a question of going out there and using all that knowledge and data that's available. And the fact that all these people have shared their experiences with you actually makes it so much more powerful.
Actually, that's the best part of being a journalist as well. People care to talk to you, really intelligent people care to talk to you. That's the blessing of this profession. But Vetri, finally, I can't believe you joined in 1994. I mean, you're already almost 25 years in the investing business. How should people, as they age, change their perception of investing? I mean, even if you talk to us about which kind of funds they should choose, I'm sure a lot of people are listening.
I think it's always evolving, and I think the thing about investing is, again, as I said, the toolkit is sort of the same, but the context keeps changing. And I think, therefore, the most important thing in investing is actually to have an open mind and be willing to revisit the investing case when the facts themselves change, and not to get wedded to a dogma. And unfortunately, just as in other things in life, people unfortunately get too much into dogma about what works and what doesn't work, whereas the reality is that, as I said, things change. And I gave you that example. To me, 1994 to 2003 was about stock picking, but 2003, 2008 was about how global macro could make such a big difference. We'd never seen steel companies, for example, make the kind of returns that they did during that period. So it's always evolving, it's always changing. Keep an open mind, but have a basic investing toolkit, because that will prevent you from creating really big blunders.
Okay, so then, we get so much from our teachers, but seldom do we give back. How do we give back to the education system or to our teachers?
Yeah, thanks, Sonia. That's, a wonderful question. And, I think we should do more to help our own teachers, to remember them, to honor them, because it is genuinely a noble profession. And I should say, more on a personal note, just recently we had Guru Purnima in the month of July. And at my old alma mater, Indian Institute of Management, Bangalore, a lot of the students of my batch and other batches came together to make a significant contribution of almost 2 crores to the institute, to rename a classroom after one of the teachers that we greatly loved and respected, and she was there to grace that occasion. And to the institute, it gives funds which enables them to invest for students who are going to go to that institution down the road. And I think those of us who've enjoyed a fair degree of success in life, we should look at ways to re-engage with those institutions and with those people which made such a big difference in our lives early on as teachers, and how can we give back to them, either in terms of money or in terms of kind, by being able to spend some of our time with those institutions. So I would certainly urge, using this forum that you've given me, that all of us who've benefited from this education system should look to re-engage with that system and do something about improving the quality of education in the country.
Wow, that's a great lesson. You do walk the talk. Thank you very much, Vetri Subramaniam. It's a lesson for me, at least. I will foregather with my classmates, whomever I can. I came from a very humble school, but not humble teachers, very good teachers. So yes, that's a great way to give back. Thank you very much for joining us. Well, we need to take a break. We are going to focus back on macro headwinds, what Vetri was talking about. We have yet another very great teacher of the markets. B. Prasanna, Head of Global Markets Group at ICICI Bank, joins us. Welcome back. We have to speak macros because that's the big headwind at this point in time. And joining us now is B. Prasanna, Head Global Markets Group at ICICI Bank. Good morning, Prasanna, and thank you very much for sparing time for us, considering that your team will be really wanting you every minute at the desk. 807. We thought that it would go down to 804 with crude falling, but 10-year is back at 807 now and climbing. What's the sense? Does it go all the way to 8/4?
So, Lata, I think, good morning, Lata. So, the primary concerns in the bond market right now are the soaring crude oil prices, which has now actually gone up by around 10% over the last 2 weeks, and also the dollar-rupee rate, which is consistently strengthening. So, these two concerns are top of the mind for all the bond market participants at this point of time. And together with a whole lot of other emerging market contagion, which is slowly spreading across various countries, there are concerns in the bond market as well as to what extent whether RBI will do something in terms of interest rate defense. So though that fears are not really going to come true immediately, the concerns are from the fact that in the credit policy, for example, the monetary policy last month, there was a view that RBI might stay pat for the next couple of policies at least, because of the words used by the Deputy Governor, who actually said that there are leads and lags in policy hikes, and they might, there was a call that they might wait. But having seen the move in both the currency as well as oil over the last 2 weeks, there are some participants were turning around to a view that there could be a rate hike as early as October. And the swap market, if you really look at it, is actually pricing in a rate hike of 25 basis points, 2 rate hikes of 25 basis points, both in the October as well as the December policy.
Okay. Prasanna, hi. Good morning and thanks for joining in. A few bankers are expecting the RBI or the Finance Ministry to announce a fresh set of measures to cool off the yields. There has been no intimation so far, but would you expect anything of that sort? And if yes, what would those measures be?
So I think the government has consciously been aware of the borrowing costs which have been consistently going up, and they have been managing to some extent in the past few months in terms of whether it is to reduce the borrowing program in the first half. They reduced it by 50,000 crores or through any other measures. But the fact of life is that to some extent this is also a global market fundamentally driven move, which is very difficult for any regulator or any government to stand by and take control of it. So to some extent I think that would also play in the minds of both the government and the Reserve Bank. Do we actually stand and actually say something which is contrary to what moves which are happening globally? So while I don't expect anything immediately, but I think things like tinkering with the borrowing program, like whether they want to go more towards the short end rather than the long end, those kind of things are always possible. And one thing which there are concerns on fiscal deficit slippage, for example. So I'm sure that, if that were to happen and at the time of announcement of the calendar, yields are going to shoot up even more. So hopefully those things should not be taken into account at this point of time, and they should be very cautious about their own borrowing program going forward.
Oh yes, after last time's December 28 announcement of extra borrowing, I think the government will know when it should not spook the market with any changes in borrowing. But just to go back to the previous answer, you were saying that the market is now factoring 2 more hikes. In that case, is 807 pricing that, or should we expect the yields to rise even further?
So Lata, I was deriving the pricing from the swap market. Okay. So it is difficult to really figure out from the GSEC yield curve as to what rate hikes are factored in, because a whole lot of other inputs goes into GSEC yield curve, like demand and supply and so on and so forth. So from that perspective, I would only say that while the OIS market is actually predicting 50 basis points of rate hike, it is not to say that yields will not go up if actually a rate hike were to happen, because now we are very clearly in a rate hike cycle. When we started the cycle, it looked like 25 and done, then it looked like 50 and done, then it looked like there might be a longer pause, and after which RBI will come and hike. But it now looks like there might be an imminent third hike, if not in October, at least by December, and then a fourth hike by February or April. So in this kind of a scenario, it is very difficult for any market participant to take comfort that the market is fully pricing in and hence bond yields are fully reacted. Obviously, if a rate hike were to come in, yields will go up a little bit more. We have to counter that as the things go by.
Okay, by the way, the rupee is now gone to 71.64. The first hour of trade, the rupee did stay below yesterday's, or rather the dollar stayed below yesterday's closing levels, but 71.58 just got crossed, and very quickly it went to 71.64. So the moment yesterday's high got crossed, there's a sharp spike in the price of the dollar. Other markets are not showing so much, but we have to worry about 71.64. Prasanna, yesterday there were some market participants who were saying that exporters are asking whether they should hedge not just 3 but 4 months, 6 months forward, and importers were shying away from buying dollars. The sense I got was that there is an exhaustion of selling, exhaustion of at least buying dollars. What is your sense? Are we is the correction over, or do we overshoot even 73?
No, so Lata, I don't think it's very difficult to get a gauge of all the clients, all the exporters and importers as to what exactly their views are. But I will just say that that's probably not what the signal that I got when we were speaking to clients. Exporters, for example, are still not looking at this as great opportunities to go and outright sell in the forward market. They're actually using option structures, which actually enables them to participate a little bit on the upside, which basically goes to show that even though they realize it's a good level, they probably think that they will get even better levels and they don't want to lose out on that opportunity opportunity to sell at a higher price. And similarly, importers are not really, again, coming and thinking that it's a very high level, let me not buy, it will settle back below 70, so let me wait and buy. Whenever there is a dip in dollar rupee, I think they are using this opportunity to a little bit hedge. So from that perspective, I would say that a large part of this move, I think predominantly the clients do feel it is fundamentally sustainable. Maybe not, it will not go back to the 68, 69 level, but I think we are in the 70 to 72.5 kind of a range. But of course, having said that, a lot of this move will depend upon how crude oil moves. A lot of it will depend upon how emerging market currencies move, because at the end of the day, we are not alone in this world. And I think the dollar rupee depreciation from calendar year beginning, if you really see, it is more or less tying up with, say, the Chinese currency or even the Indonesian currency, give or take a few percentage points. So I think those trends are very important for us to look at.
Okay, and that is what we have been staring at. Today, they seem to show that they will not fall further. The Indonesian rupiah is still about 0.03% higher than yesterday, but the rupee has started slipping. Thank you very much, Prasanna. We are completely out of time, but thank you very much for joining us and giving us some perspective on how we should approach bond and rupee markets. We have to wrap up on Bazaar Trading Ideas on Chartbusters.